You may have heard of the term short position on a stock, or maybe short selling a stock. Shorting, to use the common phrase, can be very useful in some circumstances, but there are many downsides, not to mention lots of risk involved. So before you choose to short a stock, let's go through how short selling works on today's Cash Concepts with me, Alex Chan. You may have been in a situation where you have just valued a company and you find that the true value of the company is much lower than the current price. But you don't really want to wait for the market to rectify itself and then buy the stock. You want to take action in the stage of rectifying itself to make money. This is where the short or the sell position comes in handy. The short position is essentially a bet that a certain stock will go down. This means when the stock goes down, you'll make money. This is the complete opposite of the long position or buy position, which is the traditional method of trading stocks. This is the position which is betting for the stock, meaning when the stock does well, your holding goes up in value, and vice versa with the stock falling. Now, the short position turns this method completely upside down. So when the stock goes up in value, your position loses equity, so this is actually bad for you. And when the stock price falls, your position gains money. The short position is also the reverse of a buy position technique, which you may have heard of. Buy low, sell high. However, the short switches this to be instead sell high, buy low. You may be wondering at this point, how exactly can you sell a stock that you don't have? And how would you make money by buying low? Because surely you'd just be left with the stock of a company you don't like. Well, to answer that question and more, let's dive straight into an example. Say we have two investors, Investor A and Investor B. Now, they're both interested in the same company, say Alex's Lemonade Corporation, but for different positions. Investor A wants to open a long position on the said company, meaning he is betting on the share price going up. Investor B, however, wants to open a short position on this company, betting on the share price falling. The company's stock is worth, let's say, $100, and both Investor A and B are going to invest in 10 stocks each, worth $1,000. However, as they each have opposite positions, when the stock price moves, they both earn the opposite profit or loss. This means when the stock goes up, Investor A makes money, and when it goes down, Investor B makes money. Going back to our previous question of how to sell stocks you don't own, let's go through how each positions the investors are taking works. Let's start with Investor A. He takes a long position or a buy position in Alex's Lemonades, so all he needs to do is buy the stock. Now his aim is to sell the stock when it rises and make a profit with the difference between the buy and sell position. So an example of 10 $100 stocks, which the investor can buy at $1,000 for 10 stocks, which when the stock rises to $110, his position can actually be sold back for $1,100 with a profit of $100. With Investor B, it's a little bit different. She wants to short Alex's Lemonades, so her route in this short position is a bit different. For industry investors, they are able to buy swaps with the bank, but for retail investors, you and me essentially, it works a bit differently. Usually there'd be some sort of broker involved to act as the bank for retail investors. Say this broker has 10 stocks of Alex's Lemonades Corporation worth $1,000 at $100 per share. To short this stock, Investor B would borrow these shares from the broker and sell them immediately, keeping the remaining $1,000 from the sale. She is hoping that the price falls for the stock, so if and when the price falls, she can rebuy the stocks at the lower price and then return them to the broker, keeping the remainder of the cash. So again, an example. Say Alex's Lemonades falls to $90. Investor B would be able to buy back the shares at $900, which he owes the broker, and give them back, keeping the $100 proceeds. Borrowing these shares from the broker does come at a cost. The broker usually charged anywhere from a 2% to a 20% fee for the borrowed stock, effectively interest on the borrowed cash, like when you take out a loan from a bank. This means an £1,000 short on a stock can put you out of pocket of up to $200 before you even profit on your stock. Let's go back to Alex's Lemonade stock of $100. Now, let us move on to the possibility of the stock rising. So, say the stock rises 50% to $150. Now, to close her position, Investor B will have to buy back her sold 10 shares for $1,500. However, she only has the $1,000 from the proceeds of the stock sale previously, so she doesn't actually have the money to buy back these shares. This is where the concept of margins come into play. When shorting a stock on a brokerage account, Investor B will have to deposit what is known as the initial margin, usually of 50% of the investment. This cash still belongs to the investor and can be taken out after the short position is closed. But during the open position, the broker will hold the money as collateral to make sure the investor has enough to finance an increase in the stock price. So in this example of a short of $1,000, Investor B will have to deposit $500 as a collateral to her margin account. When there is a significant increase in the stock price, such as this example's 50% rise, the broker will give Investor B a margin call. This is basically a call to the investor to top up their margin account to make sure there is still extra money to act as a buffer for a rise in the stock price further. This is usually around 30% of the new stock position. So in our example, Investor B will have to top up her margin account with an extra $450, 30% of the new position of $1,500. This means her brokerage margin account now holds $950, with the current margin account of $950 again, a loss of $500, and available funds or a cash buffer of $450. This means, as a retail investor, unlike a long position, you can only short using a margin fund. Whilst this may be somewhat of a downside, it means you can invest using leverage. What does this mean? Well, to answer that, let's return to our original example. So, in this example, let's say the stock price drops to $50. Investor A will lose $500 worth of equity, and Investor B will gain $500. If we take the investor's returns at face value, they equate, right? Wrong. If we take their investment returns on a percentage basis, which we should, as investments are in percentages, we realize that actually Investor B has amplified returns. Right now, you might not see this amplification, but let's first have a look at what each of the investors deposit for both positions. So, Investor A has an initial investment of $1,000, buying these shares outright. Now, Investor B's investment is slightly different, only $500. How does this work? Well, let's remind ourselves how she shorts the stocks. She borrows 10 stocks from the broker, the key word here being borrowed. This is because she doesn't actually invest any money into buying the stock. All she does is borrow the stock from her broker and sell them immediately. So all she does is deposit her margin fund of 50% for the $1,000 short, which is a $500 investment. Now, when we look at the return versus the investment both investors put in, we can actually see it is very, very different. Investor A has a 50% loss, whereas Investor B has a 100% profit. This is the leverage. It means returns are amplified, both on the way up and the way down. Note, you can also get leverage with the long position with specific brokerage accounts. Leverage basically makes a position more volatile, so a stock price which moves like this instead moves like this with leverage. Just remember that leverage increases not only profits but also losses, so it's very risky. And most brokerages also charge a fee to use leverage on their platforms. This is now where we come into the real disadvantages of short positions. For one, the stock is only able to lose so much of its value. The example of Alex's Lemonade Corporation share at $100, or any share for that matter, can only lose 100% of its value, down to $0, which is quite a drastic outcome. And at times 2 leverage, meaning the volatility is 2 times the real price, Investor B, who has shorted the stock, can only gain 200% at a maximum. Now, right now this return seems pretty good, but this is the best case situation for Investor B. And you also need to remember that Investor A's best case return is infinite. Theoretically anyway, because the stock can rise from $100 to $1,000 to $5,000 and higher. But remember that investor B's short position opposes investor A's return, profits and losses. So she has a limited upside of 200%, as we saw, and an uncapped downside, meaning she could technically lose an infinite amount of money. Now, if this isn't enough to put you off the idea of ever shorting a stock, there is another serious drawback which reduces the reliability of the short. It's called the buy-in risk. Say we have a stock and you decide to short the stock at this point, since you are pretty confident that the stock price will crash in the next 2 or 3 years. Even if you turn out to be right, the stock may have a surge in the near future, and either your margin fund has become too great to handle, or your broker can literally force you to prematurely close your short position at a loss if the stock has a higher demand, or the broker just needs to return the stock to the portfolio which they took it from. This is a really significant drawback, as you may be forced to realise a loss and close your position at any time. Another, maybe not so significant drawback in shorting a stock is that you're going against the overall market trend, which is upwards around 8% annually. Similarly, the business whose stock you are shorting is always trying to outdo you with their aim to grow the business and their profits as much as possible. Also, if the stock you are shorting pays a dividend, you will actually have to pay that same amount to your broker, effectively earning a negative dividend. And finally, a heavily shorted stock can lead to a short squeeze, most recently like the one with GameStop, where industry investors were heavily shorting the stock and, as many have a shorter timescale, closed their positions, leading to like a domino effect where more and more people were forced to close their positions before their margin funds and losses were overwhelmed, leading to a sharp increase in the stock price. This can force you, as a retail investor, to have to close your position and take a noticeable loss. After all these downsides and risks to short selling, many investors tend to stick with long-only portfolios. And don't feel bad if that's the way you want to go. For lots of investors, short selling itself doesn't offer enough rewards to offset the risk it poses. You can make a lot of money out of well-placed shorts, as shown by Michael Burry in the 2008 financial crisis. But if you're just willing to speculate on short bets, be careful, as a bad placed short can end up being more than you can stand. Thanks for watching this video. If you found this video helpful, please leave a like on this video. If you enjoy what I do on this channel, please subscribe and hit the bell icon for notifications on future videos. For feedback or requests for a future topic which you would like me to cover in the next video, please leave a comment down below. My name is Alex Cham, and thanks for joining me today on Cash Concepts.